Thank you very much, Jenna. Well, for many of us, our home is our biggest investment, and your mortgage can make a big difference to how that investment turns out. Here with a look at the rates and what it means to your next mortgage is mortgage professional Elisha Ewonchuk. All right, first let's talk about those numbers, that actual inflation rate. Where are we now, and where do we think we're going in the new year?
Well, for 2012, we saw a lot of very, very low rates. So actually, first I'm going to explain really quickly what a fixed rate and what a variable rate is.
Okay.
Just to kind of give a little introduction. So a fixed rate is an interest rate that's set at the beginning of your mortgage term, and it stays the same throughout your entire term. So your payments are always the same, it doesn't change.
So I sign up and they say it's going to be 4%.
And then it stays like that for the whole term, you betcha.
Okay.
So a variable rate is a little bit different. Variable rate fluctuates with the bank prime rate. So when bank prime goes up or down, your payment will as well, and your interest rate. So that's just a little bit of a difference there. So it's a little bit riskier than a fixed rate,
okay.
Just because your payments could change. Another thing really quickly is that variable rates tend to be a little bit lower than fixed rates are because of that. Because they're based on bank prime,
and as the mortgage owner, I'm kind of betting on the idea that rates are going to go lower.
Yes. Exactly. So, so I'll talk about a little bit what they did in 2012. So
sure.
We saw bank prime stay at 3% for the entire year.
Okay, which is very good.
Yes, it's very good, exactly. And fixed rates as well are extremely low, and they've remained that way for quite a while already. In 2013, many news sources and financial experts are expecting more of the same due to a slower economic recovery a little bit. But they are expecting that bank prime could start to rise pretty slowly in this coming year. So they've been talking about that for a while, but inevitably it's going to happen eventually.
It can usually only go one direction.
Yeah, exactly. So, but it's going to go slowly. It's not going to be a quick jump or anything. So people don't really need to worry too much about that.
Okay.
One thing just to mention, when people do renew their mortgages, so let's say you've got a mortgage for 2 years already and you're going to go and renew, keep in mind that rates will probably be a little bit higher, so you're going to want to make sure you're budgeting properly for that, because your payment will probably change and go up a little bit.
So with rates pretty low and expected to rise only slightly and only slowly, is there any benefit really for me going into a variable rate mortgage? It sounds like we should be in fixed mortgages.
Well, it sounds like that, but sometimes variable rates can be better. Like if right now they're very, very good, and they're usually expressed as prime minus point something or other.
So whatever the bank decides, mine is less a number. So my bank can give me less 0.2.
Yeah, usually. Now sometimes they're expressed as prime plus 2.5, or whatever it could be. It's not usually that much, obviously, but yeah, you could get that. But the thing is that you can actually lock in your rate at any time with a variable rate mortgage as well. So if you've got prime minus 0.3 right now and rates start to climb and it goes up to 3.3 or something, let's say, then you can actually lock that in and get the fixed rate for the remainder of that term.
So while it's low, and if I think it's going lower, I can stay with the variable term.
You can stay with variable.
When I think it's going higher and I want to stop right there, it kind of sounds like a Price is Right game, doesn't it?
I know.
Like it should be a wheel or a little guy later hosting yodeling. But then I lock it down and I keep it at that rate. But I have to be aware of how I get approval for variable versus fixed. What's the difference there?
Yes, qualifying for a variable rate is different than qualifying for a fixed rate. There's something called the bank posted rate, which is a qualifying rate. Rates are discounted from there.
Okay.
The bank qualifying rate right now is 5.24%. Okay, so rates are usually discounted from there. So at a fixed rate, you have to qualify at the discounted rate, which is easy. But for qualifying for a variable rate mortgage, you have to qualify at the posted rate.
Right.
And they do this so that if bank prime goes up and your payments go up, they want to make sure you'll be able to afford your mortgage.
So that you can get both. So it sounds complicated, I know it does, but with some help, you can all make sense. And we're going to keep Elisha for a little bit longer, talk a little bit about your mortgage and mistakes people are making when it comes to paying off their mortgage. We got that and more coming up today on BT.